The U.S. bond market is sending a signal right now that many mortgage professionals may not be paying attention to, and it is directly impacting how much money your HECM reverse mortgage applicants can get access to. We're going to get into all the details. We'll do that right after this short message from our sponsor.
Liberty Reverse wants to help you grow your reverse mortgage business with our proprietary Equity IQ product suite. Equity IQ gives your borrowers access to more funds, lowers their upfront costs, and expands eligibility for home purchases. Learn more at partners.libertyreversemortgage.com today. This ad is intended for mortgage professionals only and is not a consumer solicitation. PHH Mortgage, doing business as Liberty Reverse Mortgage, is an equal housing lender, NMLS number 2726.
Thank you for joining us. A recent report highlights something unusual which is happening in the U.S. Treasury market. Demand for U.S. government debt is beginning to weaken, particularly across several recent auctions. In fact, many auctions for 2, 5, and 7-year treasuries have seen softer demand than anticipated, and that's forced yields higher to attract buyers. As one summary noted, according to MarketWatch, Treasury auctions have recently produced some of their weakest demand in years, requiring higher yields to attract buyers. In addition, recent reporting from Reuters reveals that the U.S. government is now preparing to refinance trillions of dollars in existing debt while continuing to issue new debt to fund ongoing deficits. And this has not gone unnoticed at the highest levels in our financial system. J.P. Morgan CEO Jamie Dimon recently warned, "You can't just keep borrowing money endlessly. It's going to bite." And that bite is passed on to consumers and borrowers. When demand for treasuries weakens, supply increases and yields rise. And we're not talking about a slow drift higher. From February 27th to March 27th, the 10-year CMT index surged nearly 50 basis points from 3.97 to 4.4% in just 1 month. And that is a significant move in a market that typically shifts much more gradually, and it also reflects how quickly conditions in the bond market are changing. And this is where it becomes directly relevant to you as HECM professionals, what you're doing each day. The 10-year Treasury does serve as a baseline for the expected rate of the HECM, and when the 10-year Treasury yield moves higher, HECM principal limits are eroded. And here's the part that matters most. Now, this trend may not be short-lived. Historically, strong global demand for U.S. Treasuries has helped keep long-term rates relatively stable, even when deficits were increasing. But today, that dynamic appears to be shifting. We are seeing a combination of increased Treasury supply, more cautious institutional demand, and ongoing inflation uncertainty. And that raises a second warning, as Jamie Dimon warned in a recent Fox Business interview. If people decide the U.S. dollar isn't the place to be, that would be quite a problem. In simple terms, investors are now demanding a higher return to purchase U.S. debt. That creates what we call a higher floor under long-term rates. The question is, will that floor drop when the Iran war ends? There is a potential path for lower rates, but it depends on factors outside of the mortgage industry. According to Housing Wire, Ryan O'Malley of Ducenta Squared Asset Management said, "The best case scenario for mortgage rates would be a swift resolution to the Iran conflict, which could push oil prices lower and bring rates down." However, he also noted that if the conflict does drag on, mortgage rates could remain elevated and also continue to pressure housing and lending activity. This is where reverse mortgage professionals will need to adjust their approach and thinking. If long-term rates are pushed higher by structural supply pressures, then expected rates may not fall as quickly or as meaningfully as they have in past cycles, even if the Federal Reserve does begin to ease interest rates. That means waiting for rates to improve may not produce the same results that it once did. In the meantime, higher expected rates do continue to compress principal limits, and it's making it more difficult for applicants to achieve their financial objectives by using a traditional HECM structure alone. So what can you expect? It means that we're likely entering into an environment where interest rates are less reliable and cash flow-driven solutions become increasingly important. Instead of waiting for lower rates to improve proceeds, the focus begins to shift to how we structure the transaction today. How do we help the borrower improve their monthly cash flow? How do we help them to qualify? And how do we position home equity as a flexible financial tool rather than a one-time event? In a higher rate environment, those conversations are critical. And sadly, that is exactly where many HECM pros walk away from an opportunity. A loan that is short to close does not have to be the end of a potential borrower's application. Yet, oftentimes it is. But some of the nation's top producers are consistently closing HECMs that are short to close. How? They shift the conversation from the upfront cash requirement to the long-term cash flow benefit. For example, a homeowner may need to bring in $35,000 to qualify at closing, while currently carrying a $1,900 principal and interest payment. In the first year alone, that eliminated mortgage payment represents approximately $22,800 in improved cash flow. By the end of year 2, they have recaptured about $45,000, and by year 3, that number grows to over $68,000. When the homeowner clearly understands the cumulative net benefit by bringing in $35,000 from perhaps a money market account, it often becomes a rational and strategic decision rather than a barrier. The math tells the story. And the bottom line is this: we're not going to be reacting to Federal Reserve monetary policy. We are increasingly reacting to Treasury supply and bond market demand that is swayed by world events. As one report put it, the bond market remains undefeated, and that means it ultimately is going to dictate the cost of money regardless of policy expectations. And that shift directly impacts reverse mortgage eligibility. HECM professionals who recognize this early and adjust their strategy accordingly will be better positioned to serve their clients and close more loans, even those that are short to close, in the months ahead. And whatever you do in the field today, please do not let a borrower that has sufficient liquid savings, perhaps in a low interest-bearing account, walk away from the long-term benefits of a HECM just because the HECM's proceeds fall short. What are your thoughts? Please leave those in the comment section below. And if you would share this video on your LinkedIn network, we appreciate that. Don't forget, we have a YouTube channel. If you enjoyed today's episode, give us a like. It really does help our channel and help other people find this particular episode. And each and every week, we bring you the most recent reverse mortgage related news stories in our weekly podcast, HECM World Weekly. You can either watch or listen to this episode. And for our listeners, you can find us on Apple Music and Spotify. That's a wrap for us here at HECM World for the Industry Leader Update. Be sure to return next Monday for more reverse mortgage news, commentary, and analysis you'll only find right here at HECM World. Have a great week.